Okay, in this lesson, we're going to go over a few contract variables that are associated with a options contract. Okay, we're going to cover calls, puts, strike price, expiration dates, why expiration dates matter, and why beginners should avoid unnecessary complexity. So let's be very mindful that you should absolutely know these variables before looking to purchase a options contract, right? A call means bullish, up. I'll call you up. The price is going up. I'll call you up. A put means bearish, price going down. I will put you down if you make me. A strike price is the price level that you are saying that stock price has chance to go to. The expiration date is the date the contract expires. Your stock in the contract and the strike price that you said it has room to go to doesn't do it over the expiration date time frame that you selected, then you lose. I want to add focus on expiration dates. There's for stocks, they now recently allowed specific stocks, Tesla and a few others, to have 0-day expiration date, meaning you buy the contract today and you say it will do the price that you select, strike price, do that today. And that's it. Only stocks, the minimum expiration date was 1 week. Every Friday, contracts expire. All right. Just wanted to put that in there about expiration dates. One of the biggest beginner mistakes is buying a contract without respecting the expiration date. Closer the expiration is, the faster time can work against you. There is another variable that's associated with the time of a contract that you are buying, saying that stock is going to go to that strike price. And if it takes a long time, it's a variable called theta. Theta is a value decay. If your stock, the price you're saying it has the room to go to, is taking a long time getting there, then theta decays the value of that contract, meaning goes against you, puts you in a negative. The faster your stock and the contract strike price you said it has room to go to, the more profits your contract will gain. You have to be correct on the direction. All right. If you are totally not correct on the direction, then immediately you will be in the negative. Contract you selected will be not good. What I like about stock options is you have the ability to sell the contract whenever you are not feeling okay about being down a certain amount. I teach beginners to not be down more than 15% in a trade. You are down 15%, you need to sell. Get out. Let's reevaluate. As a beginner, your focus should not be on trying to master every contract type overnight. Your focus should be understanding the direction. If it's going up, you need to be in calls. If it's going down, you need to be in a put contract. The timing, allowing it some time. You're not going to buy a 1 week expiration date contract on Thursday and it expires on Friday unless you have some confirmation in chart structure that confirms your idea. Otherwise, it would be high risk. Another thing, when we are buying a stock options contract, we are buying to open. We're buying to open at the ask price. The ask price looks like single dollar values or double digit dollar values. $1.50, it looks like that. $10.25, it looks like that. But we need to understand that we need to multiply that value that we're seeing by 100, and that is the price that we pay for any stock options contract. So the $1.50 value you potentially could be seeing for that contract is going to be $100.50 for you to purchase that contract, because when you are buying a stock options contract, you are controlling 100 shares. That's all that means. You don't have to buy the 100 shares. You don't worry about that. That's why the visual price and the price you pay is different. And that's why it's that. When you are buying a stock options contract, you are buying to open at the ask price. When you are selling your stock options contract, you are selling to close at the bid price. It's important, very important. Need you to run this back, catch that, adopt that, because it's important. When you are in a contract and you're trying to sell it, you need to sell to close at the bid price that contract is selling at the moment you're looking to sell it. Be mindful too, this is another key, be mindful, prices move rapidly. So when you are trying to click that bid price to get out of your contract, the price may have changed. So you want to make sure they executed your trade. Check your queue, the transaction queue, to make sure your transaction has been executed. If not, go in there and edit your transaction. Price may have moved from there. You need to modify your price. Keep that in mind. For now, I want you to become comfortable hearing these words without freezing up. A call, put, a strike price, expiration date. You don't need mastery, not just yet. You need familiarity and clarity. Ask price, bid price, buy to open, sell to close. All right, come on, let's get to the next one.